Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is Riskalyze CEO Aaron Klein. We're going to talk fintech and fearless investing.
Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
This is the second appearance Aaron has made on the Resilient Advisor Show. Aaron, I don't have many repeat guests. Thank you for coming back on.
Absolutely, Jay. Thank you so much for having me. Great to be here.
If you're watching this recording live on Twitter, LinkedIn, or Facebook, feel free to ask questions by simply typing in the comments section. Before we get started, Aaron, I got to tell you a story. So when I started this podcast years ago, I was scraping by trying to build an audience. In fact, at the time, only Michael Kitsis, Brad Johnson, and myself were trying to do it.
Okay.
And I sent you a cold email, and you responded at like 10:30, 11 o'clock at night. And I thought, awesome, I got him. You came on the show. You were the first fintech CEO to come on when nobody was paying attention to the show. Right after that, I was able to get all these fintech thought leaders and CEOs on. Aaron, in a small way, and maybe a big way, you helped build this audience. So I really am grateful for it.
Well, thank you. That's really kind of you to say. And honestly, I actually look back on that first podcast episode as really one of the, I tend to do a lot of interviews and media work, and some of the questions are really good and some of the questions frankly aren't. And you just asked really masterful questions. So I enjoyed the time, and it was an easy yes when you asked me to come on a second time. So thanks for having me.
Well, I appreciate Brad Johnson listening as well. I'm glad I mentioned him before he even piped in.
Hey, Brad, how's it going?
All right. So I want to start with a clip from that show. Okay. And so at the time, I don't think I was asking very good questions, to be honest with you. I went back and listened to that show, but you did a masterful job of bailing me out. But on there, I asked you what you thought fintech would look like over the next 10 years. So this was about 4 years ago, and listen to your answer.
There's going to be this big shift in whether you're using technology for technology's sake or whether technology is simply a means to an end. And we really believe that technology is not a goal unto itself. It just has to be a means to an end. And I think that the design ethos that is going to, 10 years from now, I think this is going to be true of every company. We try to make this true of us today, is that the technology needs to fade into the background so that the brilliance of the advisor's work can shine through.
The technology needs to fade into the background. Think about where you were 4 years ago with the Riskalyze tool and where it is today. You did it.
Well, thank you. That's really kind of you to say. And I, that is something that we deeply believe. I think that there's a lot of the stuff we see out there in the technology space, not frankly just in the financial advisor space, but all over in technology, where it really looks like this is technology for the sake of technology. And I think it's so critical to try to find that, it's great to innovate and be out there on the bleeding edge, but it's really critical to find that that spot where technology is that means to the end, because ultimately, particularly in our space, when we're serving financial advisors, the financial advisor's value does not come from having whiz-bang technology for their clients. It comes from the work that they do to coach their clients to a good outcome. And so if that tech can fade into the background, we let the brilliance of the advisor's work shine through.
Right. And you guys have evolved the platform, not only in terms of the offering, but in terms of the way it does fall right into the background. And folks don't even really know that Riskalyze is an integral part of your advisor's business.
That's how we like it. That's how we like it. And we don't feel like we need to kind of muscle in there and take credit for the advisor's work. We'd rather that the advisor take credit for the advisor's work, because you know what that does is that builds up a great reservoir of trust. I feel like during all of the normal times in the markets, the whole point is to try to build trust and continue to build this reservoir of trust and keep making deposits into that bank account of trust until we get to the point that we have something like the 2020 pandemic crash. And that's the moment when that trust gets tested. That's the moment when that advisor draws on that reservoir of trust or draws on that bank account of trust and says, hey, like, the people who do the worst are the ones who sell at the bottom of these 5% probability events that I've been telling you about with this risk number thing, right? And so you don't want to be one of those people who does the worst because you sell at the bottom of a 5% probability event. You want to be one of those people who sticks it out and says, my plan was right, and I'm going to stick with this. And these are the people who did really well after the 2008 crash. And these are the people who ended up doing really well after the 2020 pandemic as well.
Aaron, I have to think, being a data-rich company, you probably have some analytics that could speak to that. What did you guys find last year?
Yeah, it was such a fascinating year last year. And first of all, at its core, like, I think it's important to set the table by saying, we have consistently believed that you cannot predict the future, right? So we're not going to sit there and try to predict or guess that if certain market events occur, these are going to be the results in the markets. These are going to be what the S&P 500 is going to do or what interest rates are going to do. I think that is unknowable. And I think that, trying to guess what will happen there, that's something that, active fund managers probably need to do. That's not something that financial advisors want to base their clients' portfolios on, right? And so as a result, we've taken this view of, like, we're going to only use historical data to inform risk modeling, right? So we're equipping advisors with that talk track that says, look, here's the 95% historical range for your portfolio, right? So over the next 6 months, there's about a 95% chance that if history is any guide, you'll end up somewhere, between this down number and this up number, right? Red and green. But let's be clear, there's 5% of the risk we can't quantify for you. And those are those 5% probability events. Now, in, late February, early March of 2020, my message to financial advisors was, this is it. Like, our words were, it's game time for advisors. We're here to stand behind you. We were delivering things like our volatility toolkit for advisors to help them with that messaging to say, hey, this is one of those 5% probability events. And, time to help educate our clients on how to hang on through, what's going to be a difficult period. And our expectation was, Riskalyze, portfolios that had gone through the Riskalyze process were going to fall out of that 95% historical range, right? Mm-hmm. And that was our expectation. Turns out, this is why we don't try to predict the future, right? We were wrong. The market did that massive snapback, okay? And this is why you don't try to predict the future and say, I guarantee you it's a 5% probability event, or I'll tell you exactly what will happen. The market's going to go down like this, and here's what's going to happen to your portfolio, okay? That's guesswork. What happened instead is that the market snapped back, and turns out all those portfolios stayed within their range, roughly in the same proportion that they did before, right? So, again, I couldn't have predicted that market snapback. We don't try to predict something like that. And by the way, we're not going to go back and rename it the 100% historical range, even though it's kind of behaved like that since 2011 when we, got into this business, right? But all that said, we still believe there's 5% of the risk you can't quantify, but it turns out the risk number really set advisors up for success in 2020.
So let's talk about the risk number.
Yeah.
So Aaron, when I'm talking to an advisor or a firm about their tech stack, we're going over the different options they have, and we get to the risk profiling tool. And I say, here are the 3 or 4 you should look at.
Yep.
Some of the times an advisors will say, I've tried Riskalyze, or I've heard that Riskalyze number doesn't work. Very dismissively about it.
Okay.
But that is something that I hear.
Okay.
Tell me, what's your response to that?
Well, my first question is going to be, okay, define doesn't work. Like let's talk about the range of what that means.
Excellent. So that is usually my question back to them.
Yeah.
What do you mean it doesn't work? And sometimes there's a flippant response because they heard it from their buddy in a chat room talking about financial advisors. So to then push a little bit more on it, a follow-up question would be like, do you think that it does not model out the client's risk correctly? They don't have the best answer there. How would you answer that question, though?
Yeah, the number one thing that I hear when I hear somebody say that and I try to dig with them is, well, it just seems too simple. It seems like risk is far too complicated to, boil it down to a single number. And I would say we had those debates inside of our company all throughout 2011 and 2012 before we rolled the risk number out to financial advisors in 2013. But ultimately, what we realized and the real power of what Riskalyze does is there's very sophisticated methodology underneath the surface of radical simplicity. And, what I mean by that is I would encourage people to go check out riskalyze.com/methodology. We go into it in a lot of depth and explain the approach we take, the data-driven approach we take using historical data in the model. And how, for example, I was just talking with somebody about this yesterday. They're like, well, we're assuming that you break this all down into asset class buckets, and then you kind of look at the historical performance of the asset classes. I'm like, no, actually, we decided, one of the things that we all learned in 2008 is that in times of stress in the markets, all the correlations go to one, right? And so the reality is that all the securities did not go to one. Okay, they actually behaved a little bit differently. So what we made this fateful decision back in 2011 and 2012 to architect the platform to go down to the securities level. And so literally, when we're looking at the risk of a portfolio, we're taking each individual security and strategy and product in the portfolio. We're using all of its price history, back usually about a 10-year time period. There's a couple different, risk modeling approaches the advisor can choose, but typically going back about a 10-year time frame. And we always wanted to make sure it included 2008. Now we've got the 2020 crash as a data point to have in there as well, right? But you want to have a down market and you want to have an up market in the data set that you're feeding into the risk model. And then we're again, it's not just a simple averaging of that. We're also doing all the cross correlation analysis across the different securities. And so, for example, you could take two stocks that are each a risk 92. And if they were anti-correlated, you could, in theory, have a 50-50 portfolio with those two stocks that was a risk 63 or something like that, right?
Mm-hmm.
And so there's a lot of sophisticated methodology under the hood, but the key to our success has been that we built radical simplicity on top of all of that sophisticated methodology. And instead of trying to impress every advisor with our cockpit, our 747 cockpit of 20,000 switches, okay, we created something that was radically simple to use, but most importantly, radically simple for their clients to understand, because we are not in the business of telling advisors how to advise. We're in the business of helping their clients see and understand the things that they have been telling their clients for years.
Radical simplicity. I love it. So I started the year with the goal of reducing my own fintech stack, helping my clients do that, because it's starting to become a little bit overly complex for a lot of folks. You guys are doing it on the platform level for you and your team. And then all of the research that you have behind your methodology. Aaron, is it public information?
Yeah, I mean, there's a bunch of research that we've released. Obviously, it's a proprietary, piece of our intellectual property, and so I can't say that we release every single aspect of everything, but we release a lot out of transparency and out of wanting advisors to understand. We believe that if advisors do their due diligence and understand the methodology that's out there, we're going to win 90% of the time, because we think we've made the right choices to architect this for advisors who are interested in doing due diligence and want to make sure that they are acting in the best interests of their clients in that way.
Yeah, I think my answer going forward when somebody says that they don't think the number works, they haven't done any research. I think the response is, why don't you go read the research first and then decide? Because typically folks that are that flippant with a response, not only have they not read it, they're not going to read it.
Yeah, I mean, I think that can be true. And the other thing, honestly, that I've heard before from people is, well, I plugged in a portfolio of mine and I just don't feel like that portfolio is as risky as Riskalyze says it is. And, we've had, I would say, a handful, not a huge number, but like over the course of the last, 6, 7, 8 years, we've probably had, 20 to 25 advisors who've made that comment to us. They buy the product. They're like, this doesn't work. Like, I just don't feel like the risk in this portfolio is what Riskalyze says it is. And, we're always happy to take a look. We're I think, humble enough to say, well, let's make sure that we've got the right data in there, and let's make sure that that we're recognizing the securities properly. But when we do that, we typically have to go back to them and kind of say, hey, look, trust your feelings, is only for Jedis. The rest of us need to use the data and let the math speak for itself.
That's right. There's math and there's guessing. That's the
That's
bottom
right.
line.
That's right.
Yeah. Before I get to my next question, you guys are getting back on the conference circuit later this
Yes.
year, aren't you? Tell us a little bit about the Fearless Investing Summit.
Well, I mean, it's about time. You know, we've all been through a lot in our world, in our country, in our profession. I think financial advisors in particular have done so much over the last year and a half to just be heroes for their clients and change the future direction of their clients' lives in such a powerful and positive way. And it's hard work, and it's time to get out there and be able to see the world a little bit again, be able to come face to face with the rest of our profession again, be able to learn and grow and invest in our businesses again. And so we're super excited to be bringing the Fearless Investing Summit back in person. And we're going to do that in Palm Springs this fall, September 29th to October 1st. And we went out and surveyed our customer base not too long ago, and basically about 50% were ready for events, in the first quarter. About 60%, I think, were ready for events in the second quarter, and 80% were ready for events in the third quarter. And so that's why we made the call to do that. And I think the data has kind of proven that out. And so far we're actually real close to selling the whole thing out, which is exciting. And I cannot wait, because I just got to go to one of our boot camp training events for the first time in person, since this all started. The first one we'd held, which was in Dallas, Texas, and that was great. And we, I took the stage and I'm like, this is the first time I've been face to face with great financial advisors in like a year and a half. It's crazy. So I can't wait. I cannot wait for Summit. It's going to be an amazing time.
So were you nervous at all getting back on the stage since it had been so long, or was it like riding a bike?
It was like riding a bike, because, we have been doing it all over Zoom since then. So, it's not like we got to go quiet for the last, 14, 16 months, whatever it's been. But yeah, no, it was just exhilarating to get to be with the financial advisors that we love to serve.
Excellent. Yeah, Aaron, I've been thinking once I have an opportunity to get back on stage, I'm wondering how that's going to go, because it has been a year and a half, even though we've been doing these. I think what I just learned from you is, as long as you've been producing, it's like riding a bike.
That's right. Absolutely.
Awesome.
Yeah.
All right. So my last question for you, our mission at Resilient Advisor is to empower advisors to have an impact on the retirement crisis. And the retirement crisis takes many, many different it takes you down many different paths. There is financial literacy.
Yep.
But really where I think the challenge is for advisors is that couple that have diligently saved. They're sitting there in their mid 50s to mid 60s, and they have even $500,000, $1 million saved, but they don't have enough for retirement, even though they've done everything right. And what they really need to do is kind of push on their risk capacity. What advice do you have for advisors in communicating with clients the need to take more risk in their portfolios, especially as they approach their retirement years?
Yeah, that's a fantastic question. And, one that we've, thought a lot about in terms of how we equip advisors to drive that conversation, because, to speak in Riskalyze terms, what that advisor will often find is that couple in their mid 50s might have a risk number in the 30s and 40s. Okay. And they are plugging that equation into, say, our 60-second retirement map to say, is this client's risk number compatible with their retirement goal? And when they do that, it's clearly not, right? And so that is a difficult conversation with that client, right? Because we're going to have to look, there's a few levers that we can pull. We can retire a little later. We can save more before retirement. Those are not always, that one's not always as possible. We can withdraw less after retirement. That can be a painful discussion. And you're right. One of the big levers is that we can take more risk with the portfolio between now and then. What we've always counseled advisors is, this is such an important moment in your conversation with the client, because what you've got to do is you've got to make sure that they're bought into that decision. Because I'll tell you what, the worst case scenario is if you convince the client to take more risk in the portfolio, the market takes a step back, the client freaks out, goes back to the risk 35 at the worst possible time when the market is taking a dip, right?
Yep.
So you really do have to have a conversation with them about saying, okay, like the easy answer to this question, frankly, is to invest you like a risk 60 for the next few years. Okay. If we do that, we can see how it goes green and we've got the runway to get there. But here's the catch. Like, you've got to be comfortable with this being your 95% historical range, right? With it being normal for your portfolio to be down, 10% in a 6-month period instead of 4% in a 6-month period or something like that, right? You've got to be comfortable with that, because if it drops and the market takes a step back and we sell at the worst possible time, that's going to blow up your retirement. It's going to be even worse than if you just drop down how much you're going to withdraw for retirement. So let's make a decision, but we got to stick to our plan once we decide, right? Yep. And that's the kind of conversation that advisors have to have. And you know what? That's the kind of conversation that makes that advisory fee worth its weight in gold. Okay, that's an advisor earning their money. And I love to see that happen. Advisors, I think, don't understand the value they deliver to the world. And that's it. When you can get clients to fearlessly go, I know what to do and I've got a plan and I'm going to stick with it. That's when advisors have earned their fee tenfold.
Aaron, on our first podcast, you said being a financial advisor is one of the noblest professions out there. And
100%.
it's for that very reason right there. You can save people's retirements by presenting things in a way that they can understand and take the appropriate amount of risk. You're such a great advocate for financial advisors. If you're listening to this on audio, make sure you follow Aaron on Twitter and check out Riskalyze and what they have to offer at riskalyze.com. That is riskalyze.com. Aaron, thanks so much for coming on.
Thank you, Jay. Thanks for having me.
Are you struggling to hold your team accountable? Do you struggle getting them to see your vision and drive results? The Resilient OKR system for financial advisors could be your solution. OKR is an acronym for objectives, which are your big inspirational goals, and key results, which are how you and your team are held accountable. This is the Silicon Valley method that drives growth at major companies such as Intel, Google, BMW, and Disney. Move your business results away from opinions and measure it with data.
Pick up your complimentary access to the Resilient OKR system for financial advisors by visiting resilientadvisor.com/OKR.